interest rates, basically are to the value of assets what gravity is to matter, essentially, and that is the yardstick against which other values are measured. I mean, if I could reduce gravity's pull by about 80%, I mean, I'd be in the Tokyo Olympics jumping. And essentially, if interest rates were 10%, valuations are much. So you've had this incredible change in the valuation of everything that produces money, because the risk-free rate produces really short enough. Right now, nothing. It's very interesting. I brought this book along because for 25 or more years, Paul Samuelson's book was the definitive book on economics. It was taught in every school, and Paul was the first Nobel Prize winner. It's sort of a cousin to the Nobel Prize. They started giving it in economics, I think, in the late 60s. He was the first winner from the United States. And Paul became the most famous of his time. So I looked up in the back under interest rates. I looked for negative interest rates. There's nothing there. So I finally found zero interest rates. And Paul Samuelson, brilliant man, after a couple of hundred years we've had of kind of studying economics, basically, he said that you can conceivably, technically, you can conceive perhaps of negative interest rates, but it can't ever really happen. And that was, in the 1970s. This wasn't back in the dark ages, and this was and no economist wrote up and said, this is a terrible line to have in a book or anything. And here we are in this world where we had zero interest rates last week or this week on a four-week note. And Berkshire Hathaway, which has more than this, but let's say we had $100 billion in Treasury bills. We have more than that. Before the pandemic, we were getting about $1.5 billion from that a year. At present rates, if it's 2 basis points, we'd get 20 million. Imagine your wages going from $15 an hour to 20 cents an hour. So it's been a sea change, and it was designed to be that. I mean, it was that's why the Fed moved the way they did. They wanted to give a massive push, just like Mario Draghi did in Europe in whenever it was 2012, when he says whatever it takes, and they went to negative rates. And the Fed has said it doesn't want to go to negative rates, and I think the Treasury actually has got some small bar. But if present rates were destined to be appropriate, if the 10-year should really be at the price it is, those companies that the fellow mentioned in his question, they're bargain. I mean, they have the ability to deliver cash at a rate that's, if you discount it back, and you're discounting at present interest rates, stocks are very, very cheap. Now the question is what interest rates do over time. But there's a view of what interest rates will be based in the yield curve out to 30 years and so on. It's a fascinating time. We've never really seen what shoveling money in on the basis that we're doing it on a fiscal basis while following a monetary policy of something close to zero interest rates, and it is enormously pleasant. But in economics, there's one thing always to remember: you can never do one thing. You always have to say, and then what? And we're sending out huge sums. I mean, the President said it on Wednesday, 85% of the people were going to get a $1,400 check, or 85%. And a couple of years ago, we were saying 40% of the people never could come up with $400 of cash. So we've got 85% of the people getting those sums. And so far, we've had no unpleasant consequences from it. I mean, people feel better. The people who get the money feel better. And people who are lending money don't feel very good. but it causes stocks to go up. It causes business to flourish. It causes an electorate to be happy. And we'll see if it causes anything else. And if it doesn't cause anything else, you can count on it continuing in a very big way. But there are consequences to everything in economics. But that is why the Googles and the Apples, when we don't own Google, we don't own Microsoft, but they are incredible companies in terms of what they earn on capital. They don't require a lot of capital, and they gush out more money. And if you're trying to find bonds that gush out more money from the federal government, we got $100 billion that's gushing out, like, 30 or $40 million a year, or whatever it may be, depending on the short-term rates. So that puts the pressure on, which is exactly, of course, what the monetary authorities want done. I mean, they're pushing the economy and they're doing it in Europe, even more extreme. And they're pushing, and we're aiding it with fiscal policy, and people feel good, and people have become numb to numbers. Trillions don't mean anything to anybody. And $1,400 does mean something to them. So we'll see where it all leads. But Charlie and I consider it the most interesting movie by far we've ever seen in terms of economics, don't we, Charlie?
I don't think any of us know what's going to happen to this stuff. I do think there's a good chance that this extreme conduct is more feasible than everybody thought. But I do know if you keep just doing it without any limit, it will end in disaster.
It reduces the value of float by a substantial amount. And we have a flexibility with our float that virtually no one has. And I've written about this in the annual letter. But the value of float has gone down dramatically because everything is off of interest rates. And when you get to negative interest rates, if a country can borrow at negative interest rates, you get into something that's kind of akin to the St. Petersburg paradox. And those of you who want to go to search, you can find some interesting things on it. But it becomes infinite. It's a crazy consequence of a bunch of abstract mathematics where you get there. But you lose gravity entirely. And if you tell me that I'm going to have to lend money to the government at minus 2% a year, and I'm talking nominal figures, not you're just telling me how I'll go broke over time. if I do that, so it pushes you to do other things. And of course, we've seen it. Well, we saw the rest of the world do it in even more extreme fashion, but nobody, Paul Samuelson, brilliant man, nobody thought you could do this, and we don't really know what the consequences are. But we know there are consequences, obviously.
And I think one consequence of this present situation is that Bernie Sanders has basically won. And that's because everything boomed up so high and interest rates so low. What's going to happen is the millennial generation is going to have a hell of a time getting rich compared to our generation. And so the difference between the rich and the poor in the generation that's rising is going to be a lot less. So Bernie has won. He did it by accident, but he won.